Hello, everybody. I am Adam Grimes. I am the CIO of Waverly Advisors, and I want to share a few thoughts with you today about a tactical setup that we see emerging in the gold market. Before I do, I want to begin by just telling you a little bit about Waverly Advisors, and I won't read the bullet points here. I'll trust your literacy to be able to read the slide, but just a couple highlights. We are a tactical research and advisory firm. We do incorporate a macro perspective and an awareness of narrative and news items into our work. But our research, trades, and risk management are based primarily upon a tactical approach. We do cover major liquid traded markets, and this would include world equities, equity sectors, currencies, rates, commodities, and we do a significant amount of options work also. The thing that is unique about our approach is that it is based upon our proprietary tactical and risk management approach. And just to tell you a little bit about that, we use the word tactical in contrast to traditional technical analysis. And the reason for this is that much of what passes for technical analysis is actually market lore and superstition. Some of it works, but the vast majority of the things people believe work in markets, just for instance, moving averages, there are no statistically verifiable price tendencies around these tools, and it's impossible to derive a quantifiable edge if there's no statistical edge. So our work is a significant departure from most of traditional technical analysis, and because of that, we developed our own approach based on our own research into price patterns, and we're able to offer a significantly different perspective from much of the other work out there. Our conclusions are different. Sometimes, of course, they will align. It goes with the old saying, sometimes the crowd is right. And, there certainly are times that we're able to point that out. But we do provide a significantly different vantage point. And our method does work. We have 3 years of published research and are having good success with our approach and actual asset management. So we have found a price pattern approach that does offer an edge in markets. And I do want to share a little bit more here. The way we think about markets is that usually they are random. Usually markets are efficient. And when I say efficient, I mean this in the academic sense of the word, that new information comes into a market, it is quickly and appropriately processed and immediately reflected in the price of the assets. And when this happens, markets move, random walks predominate. That you are just as well off flipping a coin as you are trying to predict the future path of the market, because there actually is no technical, no statistical, no quantitative edge in the market most of the time. This is normal. However, there are times that we can see developing patterns setting up in markets that suggest that the potential for a move exists. And this is a reflection of human psychology and buying and selling pressure in these markets. And when we do see the setup condition, what this shows us is that there is a tilt from the baseline probabilities. And the baseline probabilities being essentially 50-50. That's not exactly correct because many markets do have a drift component over a significant period of time. For instance, stocks go up. So aside from that baseline drift, which you can capture through indexing, we see a setup condition that tells us that forces may be aligning to provide a statistical tilt, a statistical edge. However, we do not enter trades until we see a clear tactical trigger. We may note the setup conditions, we may note the potential, but we do not actually take the trade, or we do not actually issue the research call until we see confirmation on lower time frames. And what this basically allows us to do, to move through this cycle of a market being random with no edge to a setup, and then when we actually see the trigger, what we're doing when we act upon that trigger is we're jumping on a train that is moving in the right direction. And that provides a very powerful confluence of momentums on various time frames, and also usually lets us manage risk very well because we're able to see very quickly if the trade is correct or not. So the pattern that we want to look at today, and I'll show you schematically here. Imagine that this is a traded market. So the black is price movement and coming up against a potential support level. And you cannot see, imagine off to the left of the chart. Of course, there are structures or reasons that we're defining this as a potential support level. Now, the thing that I want you to notice with this pattern is that each of these bounces is lower. I guess actually the proper thing to say is each of the bounces is less. And by less, we mean less height, less price movement, less momentum. Many times there's less volume. There's also less volatility on each of these subsequent bounces. And this is an area where, traditional technical analysis tells us that a support level is valid, is stronger, the more times that it is tested. This is one of the pieces of market lore that we have found to be not correct. In fact, these multiple tests of support, particularly when you have the confirmation of lower momentum, less price movement on each bounce, actually sets up a very good potential break of this level. And what you will see, and you certainly will see when we actually look at the market, the gold market, many people are taking long positions and they're putting stops somewhere in this red area. So we have additional momentum or motivation for the trade. If those stop levels are hit, they will push price even more quickly in the direction we want it to go. So schematically, what we would expect to see is that as these stops are hit on a breakdown below support, as the stops are hit, we see a strong downward leg, and then the safest entry would be to look to position short in this first consolidation. And again, this is only a schematic. We could not be sure that the market will play out this way, but this is kind of the framework of the pattern that I want you to keep in mind as we flip over next and look at the gold market. So you can see here is a weekly chart of gold extending about 2.5 years back. And notice that we have this pattern setting up over approximately the past year. It's a very similar pattern to what I just delineated. You have a number of bounces off of this support level, and each bounce is showing less buying conviction, less momentum. In addition, it is easy to imagine that there are a number of people, and this would not necessarily be a wrong trade, but there are a number of people initiating or adding to long positions with the idea that they can get out of those positions if the support level breaks. This is good for us because it allows us to locate the stops, which in this case in gold futures based on December 2012 gold, we would expect the stops are clustered somewhere roughly in the mid 1500s. And support levels and stop locations are not precise knife edge levels in the markets. They're rather fairly wide zones, and we look for action when price moves into those zones. And we also are aware that many of our readers would prefer to follow GLD. Here's a similar pattern in GLD, and we would look for those stops to be located roughly in the range of probably 142 to 148 on GLD. And the way we would play both of these trades is we would wait patiently, as we are currently doing, for a breakdown. Sorry about that, there's the end of the trading day. For a breakdown below the support level, and then we would look to position short in the first consolidation, hoping to capture some of the next leg down. And as far as potential in the trade, rough target on GLD, there could very well be more price movement here than anybody would expect. We could look for a move down to perhaps 110 or even below on the GLD, and that could be accompanied by significant volatility and a major change in investor psychology and mindset as investors approach the gold market. So that is a large-scale trade setup that we see developing perhaps over the next several months, perhaps even quarters in precious metals. We certainly will see implications for silver and the other precious metals, but the pattern is probably most clear and most tradable in gold. Thank you very much.